I'm so excited to welcome our guest speaker, Mr. Penley, and we truly appreciate him taking time to join us and share his knowledge and experience. So, just to give some background, Mr. Penley has had an extensive career spanning over 20 years in professional trading and investing, focusing on quantitative strategy development. He has led multiple teams building and deploying sophisticated technology for analysis and trading across stocks, futures, and options, giving him deep insight into how institutional players operate behind the scenes. So, in his talk, he will break down the world of professional trading and explain how advanced strategies work in practice. So, again, we are really grateful for his willingness to share his valuable perspective with our community here at the Hoperation Fund. And please join me in giving him a warm welcome.
Hello.
Okay, I'll stop.
Can you all hear me okay?
Mhm. Yeah.
Okay. Let me just make sure that I can get the screen shared for this presentation. Are you able to, it says it's host disabled screen sharing. Are you able to
Oh,
check on that?
sorry.
Yeah, no problem.
I think try again. I think I enabled
Yep,
it. Yeah,
yep,
okay.
that looks different.
Great.
Okay. Can you see things here? Do you see slide one?
Yeah.
Okay. All right. Well, thanks for that intro, Olivia. My name is Dan Penley. I'm very happy to be with you tonight. Like she mentioned, I'm here before you because I have spent my entire professional career in quantitative finance, really stretching to lots of different corners of the financial world in the Chicagoland area. I've been with several different firms on a lot of different teams, a lot of different strategies and products. Really have had exposure to quite a lot of things. Um, so I attempted to boil down some of my perspective on the industry and share some examples of things that I think are funny or interesting. And I did my best to squeeze it in here and not take up too much time. But I'm on the Discord for Hoperation, and if anyone wants to go into more detail on anything, please let me know. And you can ask questions along the way, but there is a Q&A afterward. So yeah, I'll get into it. So I figured it best to start at the very beginning. I mean, these are extremely basic ideas, but they are, when you come down to it, this is the basics of a lot of capital market finance. So as people do labor, do work, do their jobs, things like that, they earn wealth and they have to spend some of that to take care of their expenses and take care of their lives, keep themselves alive, so on, whatever. Um, but there's excess usually. And so when people have excess capital, they want to try and use that because it's just extra for them. And then there's other entities that are in need of capital and provide opportunities to create what we refer to as returns, which is when there's ways to make use of your capital and get a return over time where you get more profit from your capital than you had in the first place. And when it comes down to it, the goal of all trading and investing really is to grow your capital and also protect it. So expanding on that, let's say you have some amount of capital and you want to come up with an investment strategy, and you've got two strategies. You've got investor A and investor B, and they both invest for a year and they end the year making 36.5%, which I picked just because that's 0.1% a day. So you look at that number and they both ended in the same spot. But when you look in the details, investor A had some extremely consistent strategy where they were making money every month. And investor B had a strategy that was more of a seesaw and just happened to be up and down, but did end the year up. And there can be more extreme versions of this. I was originally thinking about putting in an investor who their strategy was to buy lottery tickets every month, and they lost money every month until the last month when they won the lottery, and their year-end return was also 36.5. But the point being, yes, everyone's trying to get returns, but there is context to these returns, and it's extremely important. So this ends up coming to sort of this core concept. And I put up the Sharpe ratio because this is like sort of the gold standard in the industry for trying to, it's one attempt to measure this concept of risk-adjusted returns, which you'll hear quite a lot if you get deeper into the industry of finance, because returns alone just really don't tell the whole story. You want to know how high quality, in layman's terms, like a stream of returns is. And there's a lot of different ways to look at that. Again, Sharpe ratio is sort of the gold standard. There's things like Sortino ratio, max drawdown. Like there's just a wide variety of ways to slice and dice like a return stream and try and attempt to like qualify it as good or bad, and really even more so, because nothing is black and white like that so much. It's more just like how do you describe it, how do you classify it, and how do you sort of rank it. So the Sharpe ratio, I use the Sharpe ratio constantly. I've used it for the last 15 years. It's a pretty basic calculation that anyone that's investing can do. I do it for, frankly, my personal investing as well, because I think it's just an important thing to track. It's the average daily return divided by the standard deviation of the returns. And sometimes people subtract like the risk-free rate and like make it a little more complicated. I don't think that's particularly necessary. But this gets you to a very, very useful measure of risk-adjusted returns. So when I think of Sharpe ratios and I think of all the trades that I've done in my career, if I try and classify them, you have stuff like that's generally called like low Sharpe. So if a strategy or an approach to investing is losing money, the mean return is negative, so the Sharpe is negative. By definition, if the Sharpe is positive, it's probably not the worst thing ever because you're making some amount of money. You're not losing money. So even the low Sharpe strategies aren't inherently bad, and I'll actually get later on into why they have a very actually important place in finance, like an extremely important place. But they are sort of a wild ride over even long periods of time. Sometimes it's hard to even tell whether they're profitable strategies. Like one great example is that you'll hear people advocate for a lot, buying the S&P 500. So a lot of, in the hearts of finance theory, people will say, hey, you buy SPY as an ETF. That's a great way to participate in the stock market. It's low fees. You participate in the US economy and you get good returns historically. And that's all true. And it is actually fine. It's probably is one of the best strategies for, just an average Joe. And the Sharpe ratio of owning the S&P is about 0.6. So that is in the low category. Then you come up to sort of the mid category, which is probably a lot of like the famous hedge funds. I don't know off the top of my head, but places like, and forgive me if you haven't heard some of these, but like Renaissance Technologies is one of the most famous hedge funds. Essentially, like Citadel, like a lot of these places where they have actual hedge funds that are managing many billions of dollars, but are very sharp with risk and incorporate advanced strategies like hedging and things like that. Things where, for example, if you own the S&P and there's a bear market, you're going to lose a bunch of money. But if you have a strategy where you own the S&P, but you have advanced hedging, maybe in a bear market, you don't lose so much money. And so then when you start to look at the return patterns, it doesn't look so bad. And you land here in this mid category. And then most of my career has been in the high category, which is strategies that are extremely sophisticated and specifically are very, very driven by technology. And I'll dig in further on what I mean by a lot of this stuff. But in fact, maybe I'll just skip ahead. But basically, high Sharpe trades, things where the strategy is so refined and so so low risk in a market sense that you can make money every day for long periods of time. It doesn't really even resemble these other strategies where you're exposed to various market risks. So digging a little more in, this is sort of like if I tried to actually break down this a little more granular. The highest Sharpe, I guess this went in reverse order, but this is high Sharpe here. So the highest Sharpe trades are high, like you might have heard the phrase high frequency trading. This is characterized by very big investments in technology, trading in very small time windows, trying to find very, very rare opportunities. The Sharpe ratios are very high. But the issue with high frequency trading is one of the big issues is the capacity is very low. And what I mean by that is, sorry, this keeps messing up. So I'll bring up an example that I guess I'll come back to a couple times. For about 10 years, one of the main strategies that I was involved in was there's this index called the VIX, VIX, and it's related to S&P options. You'll hear on financial websites, you'll sometimes hear about it as like a fear index. And I was a very big market maker in VIX futures. We used to make money almost every day. The Sharpe was about 20. And so therefore, you'd want to make as much money as possible. So in conventional finance, that would mean, investing more money in the strategy. But the strategy was, for lack of a better word, we were a middleman between other people trying to buy and sell stuff. We would take risk for short periods of time between buyers and sellers coming into the market. But we were actually limited by how many, let's say, if you called those people customers, like how many of those actually came into the market. And therefore, we actually just did as much business as humanly possible, as much as we could with the strategy. And there was no more capacity at all, or we would have used it to put more capital into this strategy. So while the Sharpe was great, and don't get me wrong, this was a great strategy, there wasn't room to make $1 billion being a VIX market maker. Whereas if you go farther out and you start taking actual risk, like let's go back to the S&P example. If you want to put huge amounts of money into the S&P, billions of dollars, you just can. So essentially, as you start to have more capital to deploy, and there's a ton of capital in the world, trillions of capital among nations and entities and so on, you're forced to move farther out this way. And so when I meant there's a place for lower sharp strategies, I meant essentially all capital has to find a home somewhere. So there's nothing wrong with these areas. And in fact, sometimes things in the middle where the returns are reliable enough that you're like very confident that you have a good business and actually you can scale it and continue to scale it are some very, very good businesses. So this isn't supposed to be necessarily like an indictment of one area of this. This is actually just like me sort of laying out how I view the entire financial landscape here. So I've talked a lot about trading strategies. You'll hear like in the industry, everyone just talks about strategies. And I think a useful thing to do here is to sort of flip that on its head. And really, the strategy comes from you think that you have an opportunity that you're going to pursue. And a strategy is like an approach that you're going to take. It's like an A to Z sort of way to manage the risk and like think of all the ways of how this is going to play out of trying to approach a strategy. So for high frequency trading, a strategy might be arbitrage. Like you might have heard this term. So in the stock market, you'll hear, people will say, oh, it's the stock market. But when you dig into the details, there's actually something like 20 different venues where you can trade stocks. There's maybe 5 to 10 actual stock markets, and then there's a whole bunch of other places you can trade stock. So there definitely can be scenarios where you have one stock like Apple and you can buy it on one exchange for a certain price and then sell it at the exact same time at another exchange. This is the way that you would end up. This is the type of risk, like what it looks like to have a strategy that makes money every day, because this strategy does not necessarily take market risk even. But you can see, even just from this like super basic example, why you might not necessarily be able to scale this to $1 trillion, because there's only going to be so much stock available for these like mispricings, like meaning there's only so many shares that are mispriced at a given time before everything becomes more efficient again. And then I already went through the example of the S&P 500, but you can view that, honestly, you can definitely view that as an opportunity, like I've earned extra money. I want to get a return. The S&P has returned, you name it, like 7 to 11% a year, let's say. That's an opportunity for me. And so my strategy is going to be buying the S&P 500. That's totally fine. They all have different properties. Just to hop in here, I don't want to spend a lot of time on this, but I just want to give the backdrop. Probably most of you guys are familiar with this, but the things I've traded, I want to bring this up before I get farther because I'm going to reference a couple of these, but the big ones are stocks, partial ownership in companies. I left out here, but I probably should include it now. You've heard of ETFs, exchange traded funds. This is a huge market. I think we might have gotten to the point where the number of different ETFs has surpassed the number of stocks, which is crazy. There's thousands of them. So there's a lot of trading involving ETFs as well as stocks. There's a lot of different types of bonds and fixed income products. There's a lot of commodity products in the market. And then there's a lot of derivatives, which are called derivatives. They're derived from the price of these derivatives are derived from something else, like something generally on this previous sheet. So if you guys are really finance geeks, you might have already heard about options. They're one of the more complicated instruments in finance. They're contracts that give you the right to buy and sell things at a set price and date. And then there's something called futures, which is sort of like, well, it's an agreement to buy or sell some quantity of something at a specific date. So, for example, tonight, some of you guys are familiar that there was a lot of activity with, war-related activity in the Middle East this weekend. And the stock market's not open, but the futures markets for the stock market just opened a couple hours ago. At 6 p.m., the S&P futures opened, for example. So even though the stock market's not open, if you want to take action on like your portfolio, you can't trade a stock. But if you wanted to say, oh, I'm so concerned about all that's happening in the Middle East, I want to hedge my portfolio right now. There's actually a way to do that. You can go and sell an S&P future, which is the same as selling 500 shares of SPY. So futures are sort of, I think of them as just like a really handy batch way to trade a lot of different things: bonds, stock indexes, commodities. They're pretty big in sophisticated trading. This concept of futures. My VIX trading market making strategy was all futures, was heavy futures. Okay. So with that backdrop, I'm going to drop in here and get into a little more detail. Everyone doing okay? Is this too complicated for, like, this isn't too sophisticated for you guys, right? You're following along? How are you guys doing? I haven't lost you, right? Okay, cool. Okay. So I'm going to drop in here. This is like maybe the most actual detailed part of things. So if this, so stop me if you have any questions. I kind of boil it down to the basics. But so when we're talking about strategies here, like going back, like some of these strategies, to put them like to give them a face, to make them real. This is like an actual strategy that, or an actual opportunity, I should say, that was huge when I was starting in the industry, like let's say between 2005 and 2012. So again, when we're talking about like the stock market, talking about futures, these are real. Like you can go down to a very atomic level on this stuff. Like a lot of times, and this is whether this is relevant or not for you guys, unclear. Like if you get into finance, I would say yes. Some of this is getting down to like a very atomic, sophisticated level. You can definitely be in finance even, or interact with the markets and not need to know any of this. But I just thought it was fun to throw a couple of like very practical examples of what I've seen that I thought, are kind of fun. And actually with two of these, they were interesting enough that people made movies and wrote books about them. So here's one. So the stock market, when you talk about the stock market, so a market now, like an actual exchange. It used to be a place where people would go, and you've seen pictures, and people would like yell and shout with tickets and make trades by hand. And when I got into the industry about 2000, that was right when they were starting to move to like stuff's getting really electronic. And now it's gotten to where what an exchange is, it's really just a server in a data center where the exchange accepts orders for their products and matches them, and that's basically where you trade. But like it's just a server, and there's 3 big data centers in New Jersey that correspond to the NYSE is in Mahwah in New Jersey, NASDAQ's in Carteret, and then there's a whole bunch that are in Weehawken in New Jersey. They're actually in physical places, which comes ironically to matter. Then you have futures. One of the biggest futures exchanges in the world, there's a couple of them. The CME group is near Chicago, because the origin of a lot of futures stuff and even options is in Chicago. So this is like abstracted away from a lot of people. But when you get down to the atomic level, there's 800 miles between CME and the stock exchange. And so one of the biggest products, there's a ton of products on CME. One of the biggest products is the S&P futures. Like I mentioned, so tonight, the S&P futures, that you can trade a whole bunch of exposure to the S&P if you want in futures in the CME. And you also, when the stock market's open, can trade tons and tons, billions and billions of dollars in S&P exposure using the ETF SPY. There's even other ETFs that match the S&P, like VOO and things like that. So the S&P is a humongous product. And there's an arbitrage between the futures, like trying to trade the futures at a price that's different than the S&P stock. And when this all started, people were using the internet. So, okay, so like, hey, I bought the S&P futures and I want to hedge by selling the SPY. And they would send an order literally across the internet, which would go through like Washington, D.C. and like a whole bunch of other cities down here that you can't really see. Can you see my mouse, by the way? Can anyone tell me? Are you able to see where I'm moving the mouse?
Yeah.
Yes.
Yes.
Okay. So yeah, so they're like down here. So it's like routing out around like this. And it took 25 milliseconds. Now, keep in mind, a millisecond is a thousandth of a second. So this is like 0.1 to 0.2 seconds, which obviously like most people just don't think that's a lot. And for a while that just was fine. Like, no, I don't think people really thought too hard about it. But the software started to speed up and people got faster in like what they cared about. Just stuff started getting more sophisticated. And there's a movie called The Hummingbird Project. Someone spent millions and millions of dollars actually to drill a hole that went straight. The entire reason for this tunnel was just for this arbitrage. And by going straight through, they managed to cut this down by like 0.1 seconds. And that they made tons and tons and tons of money of profits by being the fastest one to respond to price changes across this geographical gap. And then the funny thing is, I think it's funny, is that secretly other firms, I guess there's a thing where when you send data across normal fiber wires, you lose a third of the speed because it bounces between like the walls of the wire, the light that's traveling. And if you send it through the air, it can go pure, like the actual speed of light. The issue is the microwave towers are short range. So they had to put like a row of like, I don't know, I think 50 microwave towers. They had to buy out like farmland along this path and like put up microwave towers across the whole way to literally shave 0.002, or I guess it would be maybe 0.02 of a second. And then these people made tons and tons of money by responding faster than everyone. And you might say, well, wow, like, what do you mean? How is this doesn't even matter, like this amount of time? Well, the crazy thing is these days at almost every competitive firm, this is like commoditized now. Like this is not special. It used to be special, like to have fast software. And it's sort of like more of a table stakes now. But almost every place now, there's a concept of tick to trade where tick is an input, like a price comes in and it's something you want to do. Someone's going to sell a stock for a price that everyone wants to buy. And trade in this context is you respond. Yes, I want to buy. So this is like a round trip of a stimulus comes in and you respond. The response time of competitive firms now is less than 10 microseconds, which is a millionth of a second. So this gap here is 2 milliseconds. This is 100 times faster. So this gap between this amount of time receiving this information, you can make tons and tons of decisions on what to do in this amount of time. And this is all just to give you perspective on how fast things happen at the very, very atomic level of trading in a lot of these markets. Here's another example. So this isn't so much, this is labeled speed of information. Speed is much more relevant to the last slide. This isn't quite so much speed. This is more like the interpretation of information. Let's call it that. So we talked about S&P futures. This is an example of an order book. I'm not going to go into detail about what an order book is exactly, but basically if you pull something up, there's a line of people waiting to buy at prices that are more and more competitive. So this is the most competitive price to buy, which is the highest price. This is the lowest price that someone's willing to sell for, and then less competitive as the prices get higher. And these are always different. This is called a bid-ask spread, because if they were the same, they match immediately, and it's a trade. So you can't have them be the same, or the trades would happen. Like by definition, they will trade and trade and trade while they're matched until there's a gap and people don't agree on the price. Then you'll have like the amount of people in line. So the point of this, though, is that let's say you're an S&P market maker. So market maker usually means you're buying and selling the same thing at the same time. You actually don't have an opinion necessarily, let's say, about the direction. So let's say I don't know whether the S&P is going to go up or down, but I want to buy and sell it like a bunch of times really fast. Well, there's one trick that was a big secret for a long time that, again, these are things that, when you find them out and there's ways to make a lot of money with them. So the exchanges themselves have this issue that is like sort of untractable, where as prices move around and there's activity and people trade, their job, ultimately, as activities happening on their exchange, they have to send that information back out to people. Like the way that you get information in the first place, like when you go on the internet, you say, what's the price of Apple? Well, it's an exchange, pushing that price out to people. And they have a few different things to tell people about. They have to tell people what, the current bid and offer is. When trades happen, they have to tell people that a trade happened. But then on top of it, if you have sent them an order, so these blue buttons are supposed to be examples of, let's say I'm running a market making trade and I want to buy here. This is my order personally. Like I'm trying to buy and I'm trying to sell here. They also have to tell people that have orders that they bought or sold. So the exchange tells me whether I bought whether this order got filled. And the exchange, and not all exchanges do this the same. There's a lot of nuance to this when you get to and again, we're talking about computer speed now, like those milliseconds and microseconds, but they have to decide how they're going to tell people what's happening. And so this was a humongous deal back in 10 years ago. If a huge, let's say news came out in the middle of the day, let's say, I can't think of a great example right now, unfortunately, other than it's kind of somber, but let's say a bomb went off or something somewhere and someone saw it and sold a ton of S&P futures. Well, the first thing that used to happen was, even though this is the price and you would normally see hey, stuff's trading up here at the normal price, the first thing that you might find is that they say, this is what the market looks like. Even though there's people in line all the way up here at all these levels, guess what? You are filled, you bought here. And so savvy players would know right away, whoa, that means that every single of these orders are already filled. Like this whole strip might be filled, like something insane might be happening. And I know that because in a normal orderly market, these would have already been clearing out. But because they're already telling me that I'm getting filled way behind markets, that prices that shouldn't be trading, I can respond to that and sell like all sorts of things because I know that the price is much lower than anyone that's watching just the prices. Anyone that pulls up the prices will think the price of this is $598.58. But I already know that it's actually at least $59.57 or lower. So you can do stuff with that information that truly, it's like private, like insider. I hate to use that word because this is like not illegal or anything, but it's like essentially insider private information on the price of the biggest market in the world. So anyway, these are like opportunities that to build strategies around. And then I'm gonna do one more quick strategy.
Also,
And I picked this one
can I add
because
something really quick?
I think it's important. I brought up the S&P as a strategy, but I think it's important that there is a big spectrum of strategies. It's not just high frequency trading that has strategy, that has opportunities. So this is an example. This is an analyst that I bought research from that I thought did really good work back in 2020. And he sent out an alert at the end of August. There's a guy, I guess I won't go too heavy into this. But there was a company that's kind of famous now called GameStop. And the in a nutshell, the big story was that people thought this was going bankrupt, and they essentially overextended, and they shorted the stock. And for those of you who don't know what shorting is, they let's just say they bet that it would go down. I don't really, I think I'm running a little long. I don't have time to go into it too heavy, but tons and tons of people were betting against this company, and then quietly, this humongous billionaire founder was cornering the market in the background. And in the end, and I actually personally took advantage of this to some extent. I wish that I did to the full extent, but can't win them all. But what happened after this article? In the next 6 months, GameStop went up 8,000% in probably at least one of the most famous short squeezes in the history of the markets. They made a pretty funny movie about it called Dumb Money. It's rated R, but I checked it out. It's mostly due to language. I mean, use your own discretion, but it's a funny movie if any guys end up watching it. And so this analyst has a strategy that involves finding really interesting catalysts and single stock investments, and you can do really well and have a scalable business trading single stocks. So it's not all high frequency stuff. Here's, for example, some things I've done, and I'm currently involved in things that are longer term and lower sharp. So I do a lot of these different things. They all have their place. I'm just gonna keep going though. If someone wants to talk more about any of these, I'd be very happy to talk about any of them. But I think I'm running a little long here. How a trading system works. This is just the basics. It's all very data driven. There's inputs that go in. The big ones being price, but there's a lot of like fundamental data. You feed this in. You do math a lot of the times on these. You run your strategy, calculate what prices you think are fair, so on and so on. You might produce an action sometimes. There's a big piece about trying to figure out risks involved in things. Sorry. And then you may or may not, automatically send orders into the market, and then monitor what's happening, monitor all of these. This is where a human comes in a lot of the time, to sort of watch almost all these steps. At the highest powered high frequency firms, heavy investments in technology. I'm talking about like millions and millions of dollars, even a month. on hundreds of servers, for example. They have to buy racks and server space in data centers. They have teams of programmers building very, very fine-tuned software. Networking, so microwaves, the stuff I talked about geographical stuff, and networking inside cola centers, stuff like that. Getting the best data feeds. Talent. I mean, all these places are very, very talent hungry. Like some of the most talented quantitative minds, work in some of these industries, some of these areas of the industry. And then you need capital, of course, to run these strategies and to make these investments. I threw this up I won't spend time on it really, but this was my old, I stared at this for like several years straight every day. This was one piece of many to manage my VIX market making strategy. These were all the VIX ETFs that we had positions in. These are the VIX futures. These are different months that they expire. There's spreads between every single combination of VIX future that we were trading very actively. This is a stream of all the fills in the ETFs that we were getting and a bunch of calculations on them. In this area, these are all the fills from the futures. And these were like our profit numbers. So this day, at this point, we thought we had made $18,000. We had traded this amount of volume, and then this was our calculations on like these various proprietary ways that we looked at risk up here, and we had $13 million invested, so on and so on. And then here is a view of I guess it's hard to see kind of, but this is my actual personal view of my long short portfolio that I run personally. So this is from last week. It has my P&L. My P&L changes over various time frames, my exposures. It has like sector exposures, days till their next earnings, notionals. Ay caramba. Like value at risk, just all sorts of quantitative measures. These are my sector exposures. These are my exposures to index ETF vectors and things like that. So I just want to throw these up there to give you like a concrete idea of like what some of this stuff looks like. And then lastly, this is, for you guys as kids that are turning into adults here and thinking about, what you want to do. Obviously, if you're in this great Hoperation club, you're at least interested in finance. I don't know how many of you are planning to get involved in finance as a career, but these are the types of things that are valued at a lot of these firms. So they've gotten to be very STEM-y, like, science-like. There's and honestly, they're just getting more so with a lot of math and stats, a lot of computers, a lot of technology. These are very sophisticated problems. So these are some stuff that you probably would expect. And then honestly, like they really, really do look at a lot of these things on the right as well. Famously, there's one of the bigger firms, Susquehanna. They spend their time training their junior people in poker. Like they play tons of poker to understand risk and reward, to put people under pressure, things like that. And so a lot of these are very valued. And that is the end of this presentation. I really appreciate getting a chance to talk to you guys. That went a little actually longer than I expected. So I hope that you guys thought some of it was interesting and perhaps took some funny anecdotes away and learned some stuff. I'm more than happy to take any questions now if anyone has any. And like I said, Olivia or I can give my email. I'm one of the adult advisors. So I'll be around, after this presentation on Discord or whatever. Also, if people want to talk about really any of these topics. So with that, yeah, happy to take any questions if anyone has any. I wasn't looking at the chat, sorry. Sebastian, yeah, you're saying, can I say something, Mr. Penley? Is that still relevant? Okay, go for it.
Also, isn't it like for the like fiber optic and stuff, like it's like only by a few milliseconds, but even though it costs like $1 billion or something, like a ton of money, isn't it like worth it? Because you make like even more money off of it, including the cost of buying it than you would normally, because you can get the first trade.
Yeah, there's a ton of the capital markets are huge, and so being able to make profits on some amount of that ends up being a very good return on investment.
Like,
ironically, the guy that actually laid the fiber, I think in the end, I'm not sure that they did super well, specifically because they didn't foresee, like pretty quickly after, someone built those microwave towers and made it obsolete. I mean, people still use it to this day as like a backup option. So it's still very relevant, but like they kind of like had a tough deal on that one. But
also,
there's very high returns for these things.
isn't it like exponential? Because like in the other direction, because like most of the people have normal internet, but then once it gets faster and faster, well, it's like tiny milliseconds matter.
Well, it's more like as stuff was like not very efficient, there were a lot of profits and advantages to being like the most efficient and like making those new, like taking it to a new frontier. Nowadays, weirdly enough, a lot, like in fact, like say the microwave, which used to be super secret, like almost like a secret military operation to build this microwave path so that no one else would do it. Now you actually just anyone can do it if they want to spend some money. Like it's a public service. So a lot of this has gotten way, way, way more efficient. Um, so it's almost like now it's a lot of the stuff is just very efficient now. So you need to have it if you're going to play these games or get involved in these strategies. But it's not like really a differentiator. If that answers your question, I'm not totally sure. Okay, Brooke, I guess I can just answer this real quick. What's the reason? Yeah, okay, so this is a great question, Brooke. This is like a really unique story, and it involves the way that short selling works. I don't know if I can do this question justice, other than that you're definitely asking the right question, and normally a 9% investment in a company doesn't make a stock go absolutely nuts. The issue here was that you'll have to like Google what a short squeeze is. I just don't have time to get into the details of what a short squeeze is. But it's basically like someone cornered the market and there was nothing left, and people had to buy the stock for like any price that it was available. Sorry, I'm responding to Brooke. The people that can't see in the chat, she was asking in the GME stock why someone buying a 9% position made the stock go like completely nuts. And the reason is that really they bought the remaining shares that were available. So like there was tons and tons of people shorting the stock, betting that it would fail. And when it became obvious that it sort of wasn't going to fail because of this guy's investment, let's say, they had to turn around and buy it for any price. And so as that got crazier, it didn't matter. They had to keep buying it at any price. And it just went almost to infinity until the exchanges and the brokerages came in and made people stop buying. Does anyone else have anything that I can answer for them?
Oh yeah, I have a question. So wow,
Yeah.
thank you so much for like all of this like information.
Oh,
Like
sure. Yeah.
So I have a question. So is your work like very stressful since it's like evolving, like you're involving so much like super like like atomically fast decisions and like a large amount of money. So like is like what's it like?
Okay, so this is a personal question, so I'll answer it my personal view. I think if you're in finance, the part of finance, broadly speaking, where you are evaluated and essentially your like personal income and success and in a lot of ways career is based on performance. So like a fund manager, like high frequency trading or quantitative trading is not unique. It's just another part of finance where your performance is very important and so on. All of those where your performance matters is very stressful. I've heard it like compared. I think there's a lot of analogies. Like I've heard it compared to sports in sometimes, like in the sense that like you have to win, like it's a performance thing, in a lot of times. And you're taking risk, and there is a lot of money. It's very stressful. I've had stretches of my career that have been extremely stressful. That said, that just sort of like, I don't know that that's unique to finance. It's definitely not unique to like my area of finance, like high frequency trading. And in fact, I'll follow that up just with a quick thing, which is to say, I actually think, and I like this, that the quantitative finance and especially like some of the higher frequency finances, that the higher sharp stuff is like way less stressful, because when I was running the VIX trade, I would come in and be like, well, today's going to be like another profitable day. Like that's not stressful. What's stressful is being a fund manager and coming in tonight and be like, oh shoot, USA bombed Iran. I have to come in tomorrow and I'm going to look at my thing and it's going to say I'm down like $10 million. Like that would stress me out. But thankfully, with a lot of the high frequency stuff, you kind of avoid that. There still is some stuff, like tech issues can go wrong. And all of a sudden, there's like a very famous thing where someone was running a market making trade. This was like in 2015. Knight Capital. I'm sure you can Google it, but they were running a market making trade and someone put out a software release where instead of like buying low and selling high, it started to sell low and buy high. And it did it, and like it did it for an hour before someone caught it, and it bankrupted the firm in an hour. Like they lost like tens of millions of dollars and the firm went bankrupt. So, and I've had algos gone wild and had big losses, and it's very uncomfortable and not good. So the stress is somewhat unavoidable, but I've enjoyed a relatively, I would say, lower stress part of the market, part of the marketplace. But that is definitely a good question.
Yeah, thank you so much.
Sure. Um, if anyone's else got anything, maybe catch me in the Discord or something, because
Yeah,
I know you were gonna do a couple more things and it's already 9, so I'll bow out here maybe.
no, it's okay. I didn't like prepare a lot of stuff. I think Chloe has a question though. So like
Okay, I just don't
I'm so
want to have
sorry.
everyone here super late just because of me.
Oh, no worry.
Is there one more? Sorry, I can't. Is someone like raising their? I can't really. Let me see.
Quick question. Like, what
Sure.
technical and soft skills would you recommend for like teens who want to pursue a career in finance to develop and gain? Like, what skills would you recommend like for like a teen right now?
So if you're trying to get in finance, what's you're asking, but like about soft skills?
Like, what technical and soft skills would you like recommend?
Um. Well, I mean, truly, like, I think this is legit. Like, I didn't just put this up here just to fill up a slide. Like, these are very real things. I think I sort of hate to say it in some sense, but I think learning AI, like people are using AI a lot now. Like that is for sure a way to look at things. Like digging into how AIs work and how to apply them to finance, like that is going to be a very big thing. People are doing that more and more. But if you're trying to get into finance, it's going to be a lot of this stuff. If I'm being just super frank, like this is going to get you in the door, and then you want the soft skills once you're in the door, but that's just not really going to be what they're, looking for at first glance.
Thank you so much.
Yeah, sure.
Mr. Penley, I also had a question.
Okay, yeah, go for it.
So what is like the best tip or strategy you have for like managing your teams?
Like trading teams.
Yeah.
Oh, okay. Well, I mean, I like to, so I'm like kind of a high energy guy. I like to, um, one thing I like to do is be very, very like involved in what people are working on. Like check in frequently, like not to micromanage, but just to make sure that everyone sort of feels like they matter, because I think that they do. But I think that the more that they sort of know it, the more that it counts. I think that like having essentially like a vision and sharing it with the people, so that people are aligned, and know what they're working towards. There was like a cool paper, like this was a little while ago now, but Netflix put out a great um, article about managing flat teams, that I believe in tech and like a lot of like sophisticated roles has become somewhat of the gold standard. So like very like not hierarchical, very much like giving people autonomy, and that like essentially the concept that Steve Jobs said this in like an interview, but you bring on super smart people that you respect, that maybe even are smarter than you, and you give them a lot of rope, and that like good things basically happen. And it's not your job to micromanage and so on. You want people to be able to contribute in their own way. So I guess that's how I would answer that. It's kind of a tricky question, but
Okay, thank you so much.
yeah. Okay, Brooke is asking another question about AI. Okay, so yes, AI is evolving. This is like, okay. I don't want to talk forever, but I definitely could. Because these are like some very, very things that are hot on my mind. AI continues to evolve. Yes. So AI, like there are a bunch of new models that dropped in AI in November for people that are paying close attention. Like, for example, Claude Opus 4.5. They've already come out with 4.6. There's Chappy. They're all the big like Geminis. They've all come out with new ones, and the new AIs are like incredible for people like for quantitative finance. I'll just say that. Right now, for some of the stuff I'm doing, which is like, again, it's like lower frequency stuff, but it's intraday. I use AI. AI has built me like a 40,000 lines of code, like end-to-end trading system. Like, granted, I wouldn't be able to do this without what I know, but AI has written like almost every line of code in 40,000 lines of code of like, I don't know, 20 component automated trading system. And AI is only getting better. So the question is, what skill is impossible to replace? So like, what's weird about AI, and I don't know I don't know where this goes. I haven't maybe thought about it hard enough. Not that I could come up with the answer, but like, I guess it's like in the seed of what I just said. Like, so I have experience I've done like so many things, and it's gotten to where I actually can use AI as a tool to rapidly build a lot of the things that I've seen and like sort of replicate them, like let's say for lack of a better word. On the flip side, I don't and like here's where you have to say like how good is AI gonna get? And at this point I have to be like a pretty big AI bull because this stuff is like it's so impressive. And not only that, the pace is like just so exponential that it's just like unbelievable. So it's kind of a tricky one, but like I definitely essentially know firsthand that if you're just like, hey, like there's memes on the internet, Claude, build me like the best high frequency trading system ever, make no mistakes. And like I sure as heck know that doesn't work yet. So like currently I feel like I do need to be in the loop. But now like if I'm answering your question, Brooke, like it's like a chicken and egg thing because I feel like the answer is it's going to be hard to replicate currently some of this experience, but like it's going to be hard to get in at like the ground floor and start to build that up because it's the ground floor stuff that is the easiest to replace with AI. So like I don't know how you end up getting the senior people or like let's say more senior experienced people in the future if you're going to sort of replace the junior people with AI. So sorry, this is like a long-winded answer. And I guess I would say, okay, so like my answer, I guess, would be like creativity still seems like it's at a premium, like human creativity. Um, Definitely humans are need. I mean, really, I'm just gonna leave it at that. That I think that's the best answer among like having these other things that I already have listed with computer science, math. Like, yes, AI is very good at these things, but like you still kind of need to know the things to guide AI, and like that probably isn't gonna completely change. But at this point, like you really, really do still need creativity, like badly, in my experience. Um, to move the ball forward on a lot of this stuff.
So, do you see like AI ever like helping with designing systems, or do you think it will just like stay confined to like manually building the code, or like do you just like not know?
I think it's got to. Like it just has to. It's on a trajectory that it just like has to. I don't think it can yet. I want it to. Like I'm literally the guy like every few months because I'm not sure how advanced the models are getting. I usually every few months do try like can you make me money in the markets? Like and then it's like, well, here's this and this and this. And I'm like, no, I mean like you do it. I don't want to do it. You do it. And it still doesn't do it. So I'm kind of sad about that. But but it does seem like more and more like right now it's like completely helping me do back testing. It writes the systems. It does so many things. And in fact, I'll be honest, like probably the advanced firms. In fact, I already like know this from discussions with some of these firms. They are already using it to like get alpha. Like, and I sorry to bring up a term I didn't actually introduce, but like alpha is like basically call it like an opportunity that is very high risk adjusted return. So like to find like opportunities. I know that they're already using it to find opportunities. I just don't like haven't trained one. Like I guess I don't know how to get it to do it for lack of a better word. Like there's people that are better at AI than me and have more experience using it for this application. And I know they're already doing it. So I know it's not exclusive. I think it's like the vast minority of these strategies are AI driven, like the minority, but they exist. But I like it's just going to get more and more. I do not see a way around that personally. Um, and I don't totally know how to feel about that, but my feelings don't really matter. So I'm just trying to make sure I still understand what's going on with the AI and like try to stay sort of on the cutting edge for the most part.
Yeah, thanks.
Yeah, sure. Um, okay, sorry. Like, should I answer this? Are we good at? I'll answer this one real quick, but I know that like we're running late. Sorry. They're elaborating on creativity. Brooks asking, can I elaborate on creativity? Yes, I was thinking that when I gave this answer, like, what is that? How does that help you guys? Like, how do you cultivate creativity? That's like a good question. Uh, okay, you said, did the person who found the GameStop activity come from a creative move? So, I mean, that is a good example. It's not high frequency, but yes, actually, the analyst that came up with the GameStop idea was extremely, I would say he's extremely creative. That's like his strength. And in the markets, there's still a lot of unstructured stuff, like this like one-off GME thing, but there's one-off stuff going off all the time. Like creativity, like it's sort of like insight almost. It's like humans, you can like specialize and research and like try and have a depth of understanding on the markets that you're interested in getting involved in and how they work and things like this. And it's like it's still the humans that seems like if you can like put the pieces together better. Like it doesn't quite seem like the AI puts the pieces together really that well yet. And so when I say creativity, I mean um like a depth of insight into what the problems are and then um bringing AI to bear on sort of those as a tool more on those problems as like a very very advanced tool still, but like still like a tool at this point.
Okay, so thank you so much, Mr. Penley. I think
Yeah.
we like had better like give you like a break from all these questions. So if anyone,
Yeah. Again, like I said, I mean, I'll say it one more time, but I'll be on Discord. I'm on there all day already because that's how I communicate with other finance people. So if anyone has any questions, and I can go deep into any of these topics, I'd love to if anyone's like serious about some of this stuff. So anyway, thanks for listening, and I hope you took something away. I appreciate it.
yeah, thank you so much for like just really like
Yep.
insightful talk. Yeah.
All right. Bye.
Okay, bye.